Welcome to the Tote the Note podcast hosted by Jim Rhodes, founder and head coach at the Octane Group. Join us while we dive into the questions that matter most to buy here, pay here operators in the world of subprime auto finance. This episode is brought to you by our friends at NEO. And now, here's your host, Jim Rhodes.
Hello, friends. Welcome. I'm Jim Rhodes, the founder and head coach of the Octane Group, and I'm lucky to have with us today Brent Carmichael, who's returning from many past appearances. That's the first time he's heard the intro music. That's why we were kind of grooving to the sound of the new music there. And we've also got Chris Tiller from Car Financial. Welcome, Chris. Glad to have you here. So our listeners who've been kind of keeping up with Brent and myself through the podcast track, we have been doing a series on what we call the hardest questions in buy here, pay here. And some, frankly, Brent, have been harder than others. But today we've got kind of a tricky one, and it's an important one. We're talking about, what is kind of the industry outlook. And this is something I kind of stay away from myself typically. But today is just conversational. We're going to talk about our perspectives on kind of what's happening in the industry and what it means for our buy here, pay here folks out there. So, today I want to kind of make sure everybody understands who we're listening to. When you hear perspectives from Brent Carmichael, you're talking about somebody who's been with NCM Associates now for coming up on 15 years, Brent. I think it says November will be 15 years for you. Is that right?
That is correct.
Outstanding. And so Brent is a senior moderator and consultant, a trainer with NCM, and handles many buy here, pay here groups. And I can just tell you that I know of no one in the industry that's going to be more trusted and respected on these fronts. There's just almost no part of this industry that Brent hasn't been exposed to at some level. And so I think it's important to understand he's been in it. He's obviously been in operations, and now as a moderator, he has, moderated groups and is inside, conversations with dealers coast to coast, week in and week out. So he's certainly got a real good finger on the pulse. And I think if you think about somebody that you would want to bring into your operation, good luck getting him. His calendar's got to be stacked, but he's somebody that you certainly would want to bring in if you've got a big problem to solve. I think Brent's one of your first calls. And so we'll make sure at the end of the broadcast that you know how to find Brent. And then Chris Tiller is, somebody who's been with Car Financial in Georgia. By the way, I should make sure our listeners know, I think you're going to hear today a little bit of Arkansas. Brent's probably at his home in Kentucky today. I'm originally Oklahoma, 12 years in Texas. I know, Chris, you've got a history in Texas as well. I still hear a little Texas in your accent, but now many years in Georgia. And you're coming up on 20 years with Car Financial. Is that right?
That's right.
Outstanding. So you might take a little bit and help the audience know, kind of give your background, and then also the Car Financial background.
Sure. Thanks, Jim. I've been with Car, like you said, for 20 years. I was with another competing finance company before that for 7 years, and then was with Toyota Motor Credit out of college for 7 years. So been in the industry now for better than 30 years. Never done really anything other than auto finance across several different spaces, wholesale and collections with Toyota into management in the subprime space, into sales and sales management with Car Financial, and now I'm vice president of the division within Car Financial. Car Financial, we have 17 offices plus an additional 24 territory managers across 44 states, covering 44 states in the U.S. And then we have 2 offices in Guam and Saipan in the Pacific. So nice. We've got our wings spread pretty far and wide across the country.
And Brent, you may know too, like I don't see Car Financial out there. They're at the conferences. They'll often have a booth and we'll be able to happen by and find them, but I don't see them out there spending a lot of money advertising and promoting themselves. But they're certainly out there. You said all those territories. How many reps again on?
Well, we have 17 area managers that have our offices,
right,
and then an additional 24 territory managers who are standalone operators within a territory around the country.
Nice. So if you're a buy here, pay here dealer listening this morning and you look out your front window from the dealership and you see car driving by, that is probably a rep from Car Financial. All you got to do is reach out to them and they'll stop by and see you, but they're just not aggressive. They've got, and I will say about Car Financial, you guys have probably more programs, like more solutions for dealers, including earlier stage dealers than probably anybody I know. Is that fair?
Well, we really pride ourselves on going in and discussing with the dealer, learning the principal operations of the dealership, really getting to know what the dealer does and how what their secret sauce is to what they do, so that we can customize a program for that particular dealer. Yep. We have a normal suite of dealers. We bulk purchase receivables. We do streams of payments. We have payment sharing programs. We do backup servicing for a lot of the financial institutions that are in our space. We have custodial operations that we hold documents for financial institutions, and we do outright servicing for dealerships. Mm-hmm. So within all of that, and I don't know if I mentioned floor planning, we do floor planning also. Wow. So within all of that, we can come in and really, if I can come in and get to know the dealer and his operation, we really feel comfortable structuring a program that we feel like will work for that dealer, not necessarily the same thing that's working for the guy across the street.
Right. And Brent, did I miss anything about your background or anything you want to share about Chris's background?
No. Yeah. Chris and I have known each other for about the same 14 or 15 years I've been with NCM. And I can just tell you that they don't need to advertise, Jim. I mean, their reputation is above reproach in the industry, so they don't need to be out there spending all kinds of money because everybody knows who they are. So, which is a testament to Chris and his leadership since he's been there. I've always had great relationships with Car Financial and everybody there. So, like I said, there's one of those companies, they don't need to advertise.
Yeah, no,
they just don't.
That's kind of what we see. So our theme for today is really going to be industry outlook and perspectives. You know, we're coming through a weird time. I think we would all say that this whole COVID experience, you know, those of us who've been around this thing for 20 plus years, we've seen weird stuff. We saw the crash of 2008 and how that affected or didn't affect, folks in the buy here, pay here space. COVID was a strange phenomenon. I mean, that pandemic obviously affected buy here, pay here in unique ways. And now kind of what prompted this conversation today was that my conversation with Chris, recently was, that his perspective from, a financial guy is that, he probably sees more news about the finance sector than I would. And so, he was sharing that this particular situation is a little different. So what I thought I would do today is take our listeners, especially our buy here, pay here dealers, and think about, just bring some perspectives from some folks who have been at this a while. And so I would just say these gentlemen are not here to make predictions. In fact, let me just make sure our audience knows, by continuing to listen to this broadcast, you are not, you relieve these gentlemen from any liability. They're not making any predictions here. So this is all about just sharing perspective and our understanding of the industry. So with that in mind, I would just say, Chris, if you want to share first kind of what you're seeing about this particular environment, kind of what would be your guess about the outlook? Like if you're a dealer, and then we bump into one another at a conference, I'm a dealer and you're going to advise me, what do you feel like is different? Like what should I be doing differently if I'm in the buy here, pay here space?
Well, I think it's important to understand our customers are resilient. The difference in maybe our customer base and others might be within the fact that they need the car to get back and forth to work, and they understand that and always have. And there's a resilience to that knowledge. This is a situation that we're currently in. You and I were speaking out the other day, and I think the question that you asked was, why is this different from the 2008 financial crisis? And in my opinion, the major difference is, and in my lifetime, we've never seen inflation like we have today. And truly, while we always compete with the customer's desire to move money from one place or the other to buy goods and services, now it becomes a situation where we're competing with gas and food. And so those things will become pressure My guess would be sometime later in the summer into the early fall, we'll start seeing pressure on our portfolios from a collection standpoint. Delinquency starting to rise a little bit now, but really not as much as some might expect. But the inflationary pressure on our customer, it hits our customer harder than it hits some other customer bases. So it'll be interesting to see as we go through what happens with delinquency as we go through the end of the summer and the beginning of the fall.
Yeah. So Brent, you see lots of numbers from across the country. What's your perspective on that?
Well, I mean, Chris is, excuse me, Chris has kind of hit the nail on the head with that. The one thing that I see as a positive, though, is now this minimum wage has gone to $12 or $13 or $14 an hour, right? I mean, Chick-fil-A is paying it, Walmart's paying it. And again, spent a lot of time on the road the last 3 months in dealerships, and I'm starting to see that on credit applications. So I'm not seeing the $9 an hour, $10 an hour anymore. I'm not seeing as many 15, 17, 18s. I'm going to be honest with you that I want to see. So to Chris's point about the pressure on the portfolio, I'm kind of the same way. I think you're going to see a rise in delinquencies because a lot of these portfolios still have the guys that were making $9, $10, $11, $12 an hour, haven't gotten their raises if they're even going to get them to a certain extent, or maybe not have switched jobs at this point. So I think there's going to be a little bit of a fallout. We know all the free money now is gone, has been gone. The extended unemployment is gone. And the thing that I'm seeing currently is not as big of a fall off as we thought. And I don't know if Chris would agree with that or not, but I promise you, when unemployment kind of went away, I think a lot of us were really kind of on the edge of our seats going, okay, what are we looking at? A 20% degradation, a 10% degradation? And we really haven't seen it. But again, we just came off a tax season where tax returns were higher than they've ever been. So now we're the first time when we're kind of reality driven, this summer. Gas prices are up. Everything is up 9%. I just read today, June over June, the highest in 40 years kind of thing. But again, to Chris's point, our customers are resilient. I mean, their entire lives, they don't make enough money to cover the bills that they have every month. But they keep a roof over their head, they keep food on their table, and most of the time they keep a car in the driveway. I mean, they are the best money managers I've ever seen in my entire life. They just are. They know how to stretch a dollar around better than anybody I've ever seen. So I do think we'll probably see the worst delinquencies that we've seen year over year, November, December, January. The tougher times of the year, I think they're going to be tougher this year than they've ever been. Because there is supposedly probably not going to be any kind of relief from the inflation by the end of the year. So I think it's going to hit us more later in the year. So I kind of hope, Chris, I hope it is later as opposed to sooner, but I think you're going to start seeing it October, November, December, when delinquencies kind of rise anyway. I think you're going to see them rise just a little bit more than what they normally do. So we're trying to prepare all of our dealers and their collection departments with paying a little bit extra or being prepared for that now as opposed to when it may actually hit.
Yeah, that's excellent. I mean, you guys see much larger data pools with our clients. We see data, but not nearly the volume of numbers that you would. And we see traditionally seasonally, you'll see delinquencies low coming off a tax refund season, and they'll start inching up through the summer. And we're seeing that with all of our dealers, but nothing out of the ordinary so far. All the delinquencies in our small pool looks like people are kind of, inching toward their normal summertime delinquency. So I would agree. I think we get into late, and the fall would probably be more indicative. So just for our listeners, I would ask you stay tuned, because I'm also going to ask these folks about repos in particular, and what repos really mean to us, in this space. We want to kind of dig into that as well. So, I think that's the next part is delinquencies. We can kind of manage, we can allow a customer to ride, delinquent for a time, and that, while that can hurt us in the short term, and, and even maybe if we got a dealer out there who's with a lender and they've got some covenants, I mean, that could start to hurt. When that portfolio, pieces of the portfolio become ineligible, that can obviously have an impact, but we can typically ride out some delinquency for a time. So I think the next question is, what about repos? Like what's the outlook? And you have any information, Chris, on what we can kind of expect, or can we expect this repo or this delinquency thing to lead to higher repos and or bankruptcies?
That's a great question, and Brent may be better capable of answering it than I am. I'll give you from my perspective. We're not seeing as large a bump in repos right now as we expected. But we work really, really closely with our dealer base to get those repos back to them so that they can get those cars back on the lot and resell them. So typically it's not as big a deal with our portfolios as it might be with some others in the industry. I know that Brent deals with really large, well-capitalized dealers in the market, so he's probably better to answer than I. But and as far as the bankruptcies go, we're seeing a slight tick up in bankruptcies right now, but again, not what probably I would have expected. Now, it stands to be mentioned that we're also coming off the last couple of years historically low delinquency numbers. Mm-hmm. So when we're talking about upticks right now, we're still well below historical delinquency numbers from say 10 years ago. Also, I'll add to something that Brent said a second ago about our customer base. I read an article not long ago about savings and how during the COVID crisis, savings across the board, across all segments of society, savings had gotten larger than it had ever been before. And I read an article the other day that said that those savings that had gotten larger during COVID have now been, by and large, extinguished. Oh. So the customers, it may be that our customers and our portfolios have been propped up by that savings that they had, which is now gone. Like Brent said, I said that we would start seeing it in the late summer, early fall. Brent mentioned that he expected it to be full bore at the end of the year, the first of next year, and I think that's probably right.
Yeah. So I think I follow all that. I think if I'm looking ahead, and bankruptcies would be hard to know, but we know that employment is out there. Heck, I mean, I could go down to KFC and get same day pay, today. So, there's employment, and there's some kind of things that we're, like you say, we're returning to some normals. I mean, there's this buzz about the new normal, and so, kind of what is the, if we return to some sort of stable, environment for most of our buy here, pay here dealers, that would be around inventory. If they could get their inventory to at least stabilize, they could plan better. And we'd hope to see that, turn down, but we've not seen inventory go down in our lifetimes, have we, Brent? It just keeps creeping up. So there's probably no reason to expect. And really, cash for clunkers kicked some of this in, several years ago, and we just continue to see used car prices come up. And so that just means dealers have to also be resilient and adapt to a shifting, inventory source. And that just means our business model is going to get tweaked a little bit. But I think before we dig into that part too much, I would say, I really want to examine, Brent, because you work with a lot of dealers who, maybe are funding their own operation. In which case, if you think about a repo and the impact to them, if they work with a customer to a point and then, the customer fails and now they repossess and then they liquidate the inventory, whether they recycle that car and put it back in their own inventory through an evaluation process, or whether they liquidate, either way, they're converting that vehicle to cash and then putting another car on the lot, let's say. So provided that window is fairly short, then they're not a huge impact to them, provided that there's a buyer on the other end of that, right? If they get the replacement vehicle back on the lot, then it really doesn't hurt them a ton, provided there's another buyer to step in. So you're nodding your head like you gentlemen agree that even a repo, technically the impact is real for a short time, but then if we can take that collateral or replacement collateral and finance it, again, to another consumer, then it's a very short period of pain for us. Would you agree?
Oh, completely agree. something that our groups do is they have to do a projection for us every year in January. So they have to project out for the whole year, sales, charge-offs, payoffs. And at our last meetings that we just had in June, account attrition, what we call account attrition, was a big topic. And how many units do I got to sell each month to overcome payoffs and charge-offs? Because again, our dealers for the last, even before the pandemic, probably going back to 17, really 18, 19, became more focused on cash flow. Right. Either debt leverage reduction or complete debt retirement, one of the two. And so they were already on this path. And now they're very aware that I need 1,400 accounts paying $400 a month to pay the bills and pay back. And so they know the value of exactly what you're talking about. It's okay, for everyone I repo and everyone that pays off, I need to sell another one. And so, yeah, in the past, it's been a lot easier to do that than it is currently, just because of the cost of inventory. Now they're struggling a little bit more because I have so much more risk on the street, where the guy that came in 18 months ago, job time, residence time, income, fit this model. The guy that's coming in now, job time, residence time, income, doesn't necessarily fit the risk model that I've had in the past because of the cost of car. So there is a little bit of a struggle now in maintaining customer base. And I can tell you, unfortunately, I guess, a majority of our groups, as a group, when we take a look at those projections, we're actually on pace to lose customers by the end of the year, total number of open accounts by the end of the year, unless they exceeded the last half of the year projections. In other words, they're already behind on the projections for the year. Right. And unless they change something, they're going to end up bleeding some accounts by the end of the year. And it's a really interesting dynamic. Last year, when we did these, payoffs were at an all-time high. Number of charged off accounts were kind of at an all-time low. And now it's kind of starting to switch back to where now the number of accounts charged off is kind of, I'm not going to say normalized, because I'm going to agree with Chris. I don't compare 2022 to 2021 or even 2020. I compare 2022 to 2019 or 2018, back when it was more normal, because we've had 2 years of abnormality. Right. So if you really want to kind of see what we're doing, then we go back to 19 and 18, and are we anywhere close to those? And again, our data is similar to Chris's. I mean, we're not above charge-offs as a percent of sales, or static pools aren't running any higher than what they were in 18 and 19. Now they are running higher than what they were in 20 and 21. But again, we were kind of fantasy island for those 2 years, to be quite honest with you, from a collection standpoint. So yeah, the impact of a repossession and buy here, pay here has never been a problem, unless, to your point, you couldn't replace it and replace it fairly quickly. And it's just part of doing business. I mean, we know in our industry, we're going to have them. The best dealers offset it with replacing it as soon as possible. Right. And hopefully with a more quality one, but Chris knows that doesn't necessarily work all the time either. So sometimes we get the same or even worse than the last one, but that's why we do it.
So Chris, anything to add to that? I saw you nodding your head affirmatively through much of that.
Well, I agree with Brent. I think the key, really one of the keys to our model altogether, is getting those cars back to the dealers so that they can get them back in, rehab them, and resell them. And it's been a part of our market for as long as I've been involved in it. And I think it probably stands to reason that it will always be part of it. Brent also mentioned getting those repos back in, not being a bad thing, and I agree with that as well. Most of our guys, even today, if they don't have the sale to replace it immediately, they know that time is coming. If they can get that back and put it on the back lot and repair it as they go, they know that December, January, February next year, they're going to be selling it. Not to say that they want to hold on to it for 6 months, but normally they would go buy in October, November for tax and September, October, November in tax time for tax time. And now maybe the repos that they take late summer, early fall will assuage some of the need to go and do that.
Right. Excellent. So I got to throw in a plug. Our sponsor for our podcast is Neo. And I got to say that, I know of no other solution in our industry that can help a dealer create future value in their business more so than Neo. And what I mean by that, Neo is an underwriting, prediction tool. I mean, it's quite predictive and it's really impressive AI. And I would just say, Chris, you're somebody, and I know Brent knows this well, but when we can solve that, if we can have consistency in underwriting, that goes a long way toward, one, having a business has a value that we can translate, and then also just have metrics that we can know what's different, what's working, what's not working. So, we're happy to recommend Neo, and like I say, in full disclosure, they are our sponsor. They don't compensate us for anything, any kind of referrals, and they're busy right now because people are starting to understand what Neo, is about and what it can do. But it's a really impressive solution for being predictive about business. They can tie in past portfolios. They can pull in aggregate data, and so it's a really nice way to be able to have a chance to do something more predictive. So I bring that up kind of in the context of, there are things, as to Brent's point about referring back to 2019, Michelle and I just read something about housing here in Utah got crazy like it did in a lot of other places. And realtors were talking about, big dip in housing sales, so, and we looked at the numbers like, oh, so you're saying it's back to 2019, so it's back to normal. It's back to what we used to do. And so do we really need to get that worked up? We had an anomaly, it spiked for a time, and that's housing. But for us, I think we can, what I said to Chris when we spoke the other day is kind of the same thing. I said, nobody really invites me. Nobody wants to invite me to talk about outlook for buy here, pay here, because I'm boring on that. I just say it's probably going to be the same, like it's always been the same, and it's probably going to stay like it's been because our friend Tommy Brandis, you guys call the customer resilient. Tommy Brandis, a dealer out of Pennsylvania who just sparked 30 years in business, by the way. Tommy says he likes to refer to his customers as survivors. And I'd not heard anybody say that, and I tend to agree. That's kind of what we see about this industry. And I've been really clear over the years in articles or whatever. I will say I don't think buy here, pay here is recession proof, but I do like to think it's recession resistant. It's definitely. And I think when we spoke, Chris, you shared what Ken Shilson had said. You want to share that quote? He says it about our space?
That when the economy is bad. Or the economy is good, our business is good. And when the economy is bad, our business is great.
Yeah.
And it's specifically because the customers that expands our customer base. It gives us the opportunity to do business with more customers at that time. And it really is, there's nothing more or less to it than that.
Right. No, I follow that. So I think
Ken's a really smart guy.
Yeah, for sure. We've had Brent on, or had Ken on with Brent, on our podcast series already, and so he definitely is somebody we can all pay attention to on that. But it kind of fits with what I think about it. Things just kind of remain the same with us. That's not to say we don't have some adjustments that we're certainly making. Cost of car has been a sudden adjustment. We've seen prices creep up over the years, but we've certainly had a sudden adjustment in used car costs in the last couple of years. And so that's obviously been a thing that hurts us capital wise. So maybe Chris, I can ask you as a capital provider, what kind of adjustments have you guys made in your funding process where cost of car is concerned?
The great thing about it is, Jim, we've stayed really consistent throughout all of this. We're lucky to have really solid capital partners that have, we've got a long track record, obviously, that they believe in the way that we do the business and the longevity with which we've done it. And truly, our dealer base stays with us over the long term. Once we get somebody up and running, they stay with us, and they don't generally go anywhere else. So it's been really nice for us, and we've been able to stay consistent. One of the questions you asked me earlier about what I would tell a dealer, and I'm sure we'll get into it in a minute, but is underwriting. Just watching the underwriting right now, and if we can keep the underwriting in good shape as we go into this, it'll certainly cut down the losses that we see going forward. But we've got to really pay attention right now to what they're putting out.
Sure. Brent, anything to add to that?
Well, actually, the moderator hat now comes out in me because I'm going to have a question for Chris at this point. And I apologize if you don't want me to do that, Jim, that's fine.
Please.
It's something that, and I stay in touch with quite a few guys that do the same thing that Chris has done. I mean, what is your concern level, so to speak, with, you've heard the term water in the portfolio, right? And right now, these cars are, if you believe what you read, 40% higher than what they were in 2019, or whatever that number is at this point. What is that from your standpoint, from Car Financial standpoint, from either a debt buyer or capital provider standpoint? what is that concern level of, is it a year from now you think these are going to come back a little bit? Is it 2 years? I just spoke at a Chevy 20 group and they were asking me again, my thoughts on, when is inventory going to come down? And I think if you think we're going to get this 40% back, I'm sorry, here's the wall, bang your head here. We're not going to get that back again. We're not going to have 19 prices again. What would, if you had to, and again, not holding your feet to the fire on this, but do you think we'll get 10% of it back? Do you think we'll get 15% of it back? So like I said, if you're looking at water in your portfolio, and you guys have modeled this, Chris, because I know you guys, don't give me this, we've been consistent. Don't give me the corporate car financial answer. All right. This is Jim's podcast. We talk about truths here. You guys have got to be building in a little bit of that. So ballpark it for us. Is it, do you think it's going to be 10? Do you think it's going to be 15% water in there? Do you think it'll be a little bit more?
So Brent's known me a long, long time, and he knows that I'm not the political face of the organization. So thank heavens for that.
He's been trying this whole time, Jim, but I know him better than that. So
I will tell you, I've been in this business a long, long time, and I watched cash for clunkers come into the market and wash out. I watched a lot of highs and lows within this, and from our perspective at Car Financial, speaking entirely for myself and nobody else, we deal in a section of the market that doesn't allow for these giant back and forth margin swings. When we're dealing in a car that has a cost of $4,000 or $5,000, maybe $6,000, and you're dealing with $8,000 to $10,000, maybe $12,000 balances, we don't have the risk of the wild swings that another finance company might have that's going 72 months on a $25,000 or $30,000 truck. So for us, for those guys, I think there should, if I were holding one of those portfolios, I might be significantly more concerned about that degradation than we are in our portfolio, because we simply just don't have the room in it to fall like they do. If that makes sense or stands to reason. So when you ask the question about how much water is in the portfolio, for us, I would say it's probably in the low single digits. For another finance company is dealing in that higher level inventory or in those longer term contracts, I would say their number is significantly higher than that.
Yeah. And like I said, I appreciate it. It's a question that I've gotten from our dealers in the 20 groups. It's like, man, God, 2 years from now, these cars, if they go back down to $6,000, now I'm holding, right, in theory, 33% water in my portfolio at that point. And I wanted to hear from somebody outside, because I've been trying to reassure them, look, guys, we're not going to get the 40% back, right? This $9,000 car is not going to go back to $6,000 cars on January 1 of 2023. It's just not going to happen. Right. We'll see a little bit of relief, but I personally, and I'll go on record as the NCM or Brent, either one, I don't think it's going to come back more than 10%. I really don't. I think this is who we are, and this is who we're going to be for the foreseeable future. And I'm trying to position our dealers. Maybe I am being a little the sky is falling, chicken little kind of thing, but I'm trying to position, look, you got to get used to this inventory, this cost of inventory for your 2010 with 120,000 miles on it. This is what it is, guys. And if you're going to kind of sit there and wait and go, no, it'll come back to 6,000. Your $10 million portfolio is going to be $5 million a year from now.
Right.
And you're going to go from 2,000 accounts to 1,000 accounts like that, because you're waiting for this to happen and not to be worried about, I'm going to have a bunch of water in my portfolio, because I just don't think I think there's going to be some, don't get me wrong. I think there will be some. But to your point, that's why I wanted to hear from you, because again, you guys, huge portfolios out there. It's good to hear somebody that's kind of thinking, not necessarily what I'm thinking, but just to put their minds at ease. And look, guys, I think we're in this for a while, bad as it is. I think this is just who we are. So don't worry about the value of your portfolio. Worry about exactly what you talked about: consistent, effective underwriting, and management of that risk for that cost of car. And then the water doesn't matter at that point. I mean, if you structure effective deals, I don't care if it's a $9,000 ACV or a $90,000 ACV. If I structure the deal right for the right customer, it shouldn't matter at that point.
Right.
I think if I may, Jim, I think to your point, our customer base, our dealer base goes out, repossesses the car, brings it back in, puts it back on the lot and resells it. So where a larger dollar max ACV portfolio, say the $25,000 or $30,000 truck portfolio, those guys are typically not bringing that back in and reselling it. They're bringing it back in and trying to wholesale it. So for that guy, he's taking a loss that my dealer's not necessarily taking, as my guy is holding on to it to resell it. And the great thing about it is, without regard to what the value of it is, when he brings it back in, he's still got a lower basis in that car than he had when he sold it the first time, because he got his down payment and he got a few payments. Then he had to repossess it. He brings it back in, he resells it, he gets another down payment, and hopefully runs the term in the second customer. So it's a little bit of a different ideal than the guy that's got the really large portfolio, the really large max ACV portfolio, from what ours is seeing. A repossession to our dealer is not necessarily a bad thing.
Right. It doesn't have the same impact. So I follow that, and I think there are a couple of things, and I just need to let our listeners know this broadcast is going to run a little longer maybe than some of ours do, because we got some really important stuff still to talk about, and you can tell that we've got really folks who were deep in the trenches on these conversations, and kind of, you're sharing some things that I don't get a chance to talk about enough, and I would just say that we see the same things. I mean, we're certainly in a position to see the same impact that you're talking about from the repo. I think the thing that I look forward to having you both sound off on here is that I had a fun conversation with another lender at the NIADA conference, and so here's really the question. If you're advising dealers based on their ACV jumped a couple grand, in a 2-year span here, their customer is still employed at a similar income level. Their down payment is still the same $1,200 or whatever they had before. So from a pure finance standpoint, if I'm the dealer, my choices are to either try to run the customer's payment up, which we understand can have an impact on collections, right? If I run their payment up relative to their income, or I'm going to extend term, which kind of gets into this water in the portfolio that Brent's referring to, and I recorded some stuff out there, several months ago on that subject. But so my question of you, Chris, as a finance person, I'm the dealer again, advise me, would I be, based on your perspective on the industry, sudden jump in cost of car, and one quick aside, I just looked at dealers' numbers from last month, and they're selling around 100 cars a month, and their ACV is up about their costing cash and deal rather is up about 1,500 per unit. So that's a big number to have to adjust in your operation, right? That takes some real strategy to move those numbers in that way. And you need your lender, obviously, to probably participate in this conversation with us, because when I take that example, Chris, and I say I can either run the customer's payment up relative to income, or I can extend the term on a car that's similar in miles and age as what I was financing 2 years ago. So what's your advice to me? Is a combination, or where should I live if I'm the dealer?
This is probably the toughest conversation that we have with a dealer ever in the lifespan of that dealership, and it really is where our people in the field do us the most good, because I can go out and have, if I'm simply buying a call-in portfolio or a brokered portfolio, and I don't know the dealer, I can't have this conversation with that dealer. Mm-hmm. When we sign up a dealer, we get to know that dealer. We know what's going on with them. We know what makes their operation tick. We know what their underwriting is. We know what their normal collateral is. We know their normal terms and their normal downs, and we have the information, the data to back that up. When we go out and talk to these guys, the message, I think, especially now, is you can't just wildly throw out put a note on the books because the customer has a good down payment, or because they live in the area, or because you sold a car to their Uncle Joe before. You really have, this is one of those times where we really need to dig into the metrics. You really need to make sure that the car is sound, and that the underwriting is sound, and that customer has the ability to pay that payment. And it's funny, back in my Toyota days, they moved me from Dallas, Texas to Washington, D.C., where you can just imagine what they did with me in Washington, D.C., with my accent. They had a blast with that. But one of the first finance managers that I was ever really close friends with told me, Chris, the business is this: ability, stability, and equity. And it's never changed throughout anything and any cycle and anything that we've done. Ability, stability, and equity always reign supreme when you're underwriting a portfolio or a deal. And that's the thing, that we have the ability to go in and talk to our dealers and really have a frank conversation about it. Now, to answer your question with that background, we will expand our terms maybe a little bit, maybe give a little better advance when necessary on the right structure. We'll ebb and flow on that with the dealer. But to this same point, if a dealer came to me and he was on, say, if he was on a payment sharing program, for instance, and he came to me and said, hey, I know my normal upfront advance is this, and I need to double it because there's so much going on in the market, we wouldn't do that. If he came back and said, my advance is X, and I need just a little bit more on this car because I paid a little bit more on it, or I want to go a little bit better term, I want to go a little bit longer term on it because it's a little better car, or the customer had a little more down, or I've sold this customer 5 cars before, then we'll talk through those scenarios and make adjustments. But we have the ability, again, because of the way that we're structured, we have the ability to talk to those dealers and do those on a one-off. So we're not changing, as I said before, we're really consistent in everything that we do with the dealers, but we also have the ability to ebb and flow a little bit where we can help them on those individual circumstances in cases like that. One other thing that you had mentioned, from an economic standpoint, if the car is increasing in cost, and the customer is staying the same, but we're inflating everything else around it, I would suggest that the customer may be making a little more also. So it's certainly something you have to look at. But going back to what I said earlier, if we get a customer there that doesn't fit the car that they're looking to buy or wanting to get into the deal that they're looking to get into, you got to be able to move that customer. Just because they're coming in and looking for the Denali, doesn't mean you put them in it. It may be that customer needs something else. And I know with our dealer base, I'm preaching to the choir there, but it really becomes the most important thing today.
Right. I get it. So Brent, I know you have something to add to that. And by the way, we're definitely getting into some of the hardest questions in Buy Here, Pay Here today. So.
For sure.
I'll just tell you this, 2 of the groups I just met with, we spent 2 hours, each group spent 2 hours on this topic. And we actually identified, you have 7 controllable factors that we found to help offset risk. Going into the conversation, they basically thought they had 2, right? I can extend term or higher payments and that's it. And we identified you have direct control over cost of the car. You can just choose to buy a later model, older car and keep your $6,000 gross. So we kind of went around the room. Who wants to do that? Well, I don't want that car on my lot. Okay, great. Another area you have an impact on is the reconditioning of that car. Maybe you don't try to recondition it for a 3-year term, and because we know most of them don't go to term anyway. Well, nope, we're not going to cut our reconditioning cost, Brent. Okay, great. Gross, right? Short term. And again, back to Chris's point, you got to know your metrics. I mean, there's some dealers out there that cannot afford to cut their gross because they don't do as well on the collecting side. So they need that to make sure that their dealership stays profitable. But we found some dealers that, we could in the short term, if collections didn't suffer at all, they had some room and could still be as profitable as long as it maintained a certain volume level. So we found some positives there. Down payment was one. Obviously, if your car goes up $1,000, you can raise your down payments $1,000. And Chris, Jim, you know where that goes, right? Sales are going to go down if I have to have a $2,000 down as opposed to $1,000. So we kind of threw that one out. Interest was one that came up that has a bigger impact, believe it or not, on the deal than anything else. And when I threw this one out, I'm going to be honest with you, I thought they were going to throw me out of the meeting room. I mean, I did. I thought they were going to be on the phone call on NCM saying, we need a new moderator. This one's been drinking or something, but we can't cut our interest rates. And for a lot of them, we actually showed them their own metrics that we know buy here, pay here 101, interest should cover charge-offs, where some of them do such a good job of collecting that there is a pretty good surplus there. And again, this is not something for everybody that's listening. I'm not saying you do this as a practice for now on and ever. But again, if you're maxing out, which I think you should at 21 or 22%, I even went into a dealer's software and we brought a deal up on the screen and said, okay, look, if you go from your 24 to let's just say 10.9 on all your deals from here on out, $1,500 to $1,700 reduction in total of the payments. That's 4 months off of a term with the average payment, right? And another positive to that, short term, would be more money goes to principal than interest on that deal than it would in the past. Therefore, I'm reducing my principal balance quicker, therefore reducing my risk quicker. Right. But again, not for every dealer that you would want to do that, because some of them don't have the financial metrics to get away with that. And then the last two are pretty simple. It's term and payment, right? You can just go, look, I can't, these other five, Brent, you're crazy, I can't do anything about them. You have two choices: extend your term or raise your payments. One thing that we do with our groups, we do a deal structure analysis every October, and we look at the recent 10 deals or 20 deals. And, to Chris's point, it's ability, stability, and he's got equity. I learned it as stability, ability, willingness, and security. The saws, the force. We've been around basically the same amount of time doing the same training, I guess, back in the day. But, I see too many dealers where most of their deals were going out at a 16, 17, 18% PTI. And we've had Naveen on here with Neo, and we all know that, and Ken's even validated the number somewhere close to that 25% payment to income. If we can stay below that, loss ratio stay, pretty close. And my challenge to the dealers was, guys, you just can't let deals go out at that anymore, unless you're wanting to go 48 months or 54 months on a deal. So, I mean, if the customer can afford, based on your metrics and your history and your loss ratios, a 22% PTI, then that's what we need to be showing them. We need to show them that $110, $120 a week payment to help offset some of this. So like I said, these 2-hour discussions, the 7 points, and it wasn't, we don't tell you this is what you should do. Say, here's your 7 controllable. Mm-hmm. Which one of these can you live with if we need to change it? Which one, based on, again, not just what you want to do, but what makes financial sense for you? And the eye-opening part of it, I didn't come with these 7. We just started asking, what do we have control over? And those were the 7 that came up. And we just said, now you've got 7. You thought you had 2. Term and payment is all you thought you had. Now there's 5 others. And maybe it's a little bit of everything. Maybe I stop raising my hand at $6,000 instead of 7. Find a little bit in recon at a couple of $100, knock $500 off of sale price, get another couple $100 down, maybe come from 20 to 19% interest rate. There's 1 month, but my payment $5 times 3 years, that's $700. If I do that, I mean, we could knock off that $1,500 pretty quickly if we just take the time to look at it.
That's so good. And Chris, I do want to have you speak to the interest and the other parts he talked about. There are 2 things in there I want to circle back to.
I saw him grinning when I said that. He said, this guy's crazy, Jim. You need to get him on now.
We got to let him get in there. But one thing you said in there, Brent, that I want to make sure for our listeners to clarify. You said that interest should cover charge-offs. So I want to make sure, are you typically expecting that to do on a gross or a net basis?
On a net basis.
Okay, so interest income, just for our listeners, interest income that you bring in on a monthly basis or whatever range of time we want to measure should cover our charge-offs net of repo ACV.
Net of repo ACV. And again, Chris is kind of nodding his head. A lot of us, and Jim, we kind of learned this back in the day. That was the Jim DeVoe, God rest him, for JD Byrider, right? Your interest covers your charge-offs, and then whatever gross you charge, you get to keep. Now, some states, Arkansas being one of them, has low 17.9, I think, is their usury cap. So those dealers may struggle a little bit more, depending if they're kind of more of a higher risk. But yeah, I mean, that's one that we've always looked at. And like I said, the better dealers have, and again, let me throw this disclaimer out there. Anybody that's listening, I'm not saying this is what you should do. I'm saying it's an option, but you really have to understand, to Chris's point, you really have to understand your metrics and your business.
Yeah.
I mean, if you've got let's say you're a very good collection dealer and you've got a $500,000 excess at the end of the year, then sure, it's something I can take a look at on a short-term basis. But again, this is not something I would tell any dealer specifically, this is what you have to do and you should be doing. I just threw up the example of that and showed them that it is a significant difference. It is $1,500, $1,600 that I can cut out of a term, which for most is almost a 4-month term.
Right.
So I don't need to go 48 months. Now I can go from 36 maybe to 40 or 42, but I don't have to add that other year to it. Again, assuming that maybe I'm not getting the customer that is at the $15, $16 an hour. They're still 9, 10, 11. And I can still make that affordable for them. But yeah, I mean, the looks on the faces, I was scared. Right. I'm going to be honest with you.
Yeah.
I threw that one out there and I had about 30 guys in the room looking at me like, what the?
Yeah, right.
And I'm like, hang on, give me a minute, guys.
Security. Yeah. So no, Chris, I do want to have you speak to that, but I got to make sure I say before we get away from it, without selling anything, Brent Carmichael just took you guys inside the value of being a 20 group member, right? I mean, if you just heard what you can get out of being in a 20 group. And so I just think it's important for our listeners to recognize, these are among the kind of things that we're wrestling with out there in our industry right now. And, being part of those conversations is really important. So, Chris, what are your thoughts? We saw you smile about the interest rate. What do you think? You live out there in the Southeast where they got those 28, 29% interest rates. What do we think?
Well, we can't live without them. I'm surprised that they didn't kill Brent. I would have loved to have been there because I could have run security for him.
Yeah, right. Yeah.
But when he says they almost strung him up, I imagine that was real close to what happened. For our dealers, that interest rate makes the portfolio worth more. We're always asked, the first question any dealer ever asks us is, what do you pay? And the answer to that is, we pay all across the board. I can't tell you what I pay without looking at what you have. Just like you can't go and buy a car without looking at it before you bid on it. The higher the interest rate, the shorter the term, the better the collateral, the longer the pay of the customer. All of those things make a difference. But at the top of that list really is the interest rate. And we've done business in Arkansas for, I opened it to car in probably 1990. Brent, when did they change the usury rate there?
That was still under the old. That was under the old 5 points over the discount back in the day. And I remember we were for 4 or 5 years, like 5.25 was the max interest rate we could charge. And that was in the late 90s back in the day. Now they went to the 17, 6 years ago, I guess. What is this, 2022? So 15 or 16, they allowed them to do up to 17.9, I think is what their max is now.
Oh, and when they moved from that, from the 5% over the discount rate, and not for nothing, but there wasn't a discount rate at that point. The law pointed to a rate that was not recognized by the government, so it was really an issue. We were still a division of Wells Fargo at that time, and getting it through our corporate governance to be able to go into the state of Arkansas and do that was extremely difficult. But we persevered and we did business there. The price that we would pay for a portfolio when the rate jumped from 5 to 17 or 5 to 15, and I think it made a couple of incremental changes there. I think it went from 5 to 12 and then to where it is now. But the price that we would pay for a portfolio went up commensurate with that. It didn't follow it 1-to-1 because you're discounting bulk portfolio. But there was some commensurate increase that went along with that increase from the old APR to the new one. And that's just an example that shows the benefit of the higher APR. Now, again, we're dealing with we have plenty of dealers that are large portfolio dealers, many of whom are in NCM's 20 groups. But we also have a lot of the younger dealers in business and more moderate 15 to 20 car a month guys, even down to the 5 and 6 car a month guys. And for them, it's a lot more important for them to get everything that they can get out of each deal than it is for the guy that's got a 3,000 account portfolio, just for obvious reasons in the metrics. It just goes back to what I said originally, Jim, when we talked about the underwriting of the portfolio. Now is not the time to try to write a note on every customer that walks on your lot. You just got to try to be a little more conservative than that. And that's just going to be that way for the next foreseeable future, probably.
Yeah.
How was that?
No, that's
foreseeable
good.
future. Come on.
Yes.
That's why Brent's here as our co-host. You know, it's the good cop, bad cop thing. Brent's going to come at you a little harder.
I'm sorry.
No,
I told Jim, I said I get into my moderator mode sometimes on this, and it's like, well, wait a minute. But yeah.
So yeah, and I kick into my neutral co-host position where I can say, you know, you like that 29% in Georgia or whatever, but it sounded like you made the 18% work in Arkansas too. So I'm just saying there's a model there for both. We could probably make both work. And I think it's one of the things, to Brent's point, it's one of the pieces that we need to kind of keep in our tool belt, so to speak, as to way to navigate from here to, you know, for me, Brent, it's 2 years out. Like if I'm advising a client, I'm just saying, let's just be prepared to, you know, let's get us to 2 years and then let's regroup. You know, it's kind of where I'm thinking about this. And so that just means interest could be one piece of that. Certainly, I'm just uncomfortable with the idea of pushing PTI too high. I think that just puts pressure on collections and makes for an unhappy collector and an unhappy customer for 3 years. And so I just, you know, I'm trying to strike that balance. And so I don't have the answers either. I think as we wrap up here, what I would do is, you know, there are folks in our industry probably, and I don't necessarily know them at this point, but there are folks in our industry who are deep inside these metrics that we're talking about. And I would like to ask you guys to help. Let's find them and let's bring them to this conversation, and let's go a little further on that subject, because I just know of nothing that's more important to buy here, pay here right now than those things. I think, you know, what we talked about earlier, consistency in underwriting is going to be important. Consistency in business model probably is also going to be valuable. And I think what we see, Chris, I heard you describing earlier, you know, those people with the $25,000 trucks, you know, I think of that buy here, pay here operation as kind of a top tier, or they're almost serving a C paper customer, where we're maybe a D paper customer in you know, the buy here, pay here dealers that we work with day in and day out. So I almost view it as a different model, different strategy. But for those folks that we work with day in and day out that are really in the buy here, pay here space doing, you know, the D paper customer and really financing that customer maybe again and again, then they might have a little different strategy to invoke here. And so again, that's a conversation we'll have to save for next time. I think we can probably wrap up there. We won't cover it all today, so we have to break it off there somewhere. But yeah, so gentlemen, I appreciate it. And again, you can find Chris Tiller at carfinancial.com. Chris, you want to share your full email address for anybody who wants to reach out to Chris?
Yeah, it's real simple. It's chris.tiller@carfinancial.com.
Okay. And I know Brent is B. Carmichael at NCM Associates. NCM, by the way, has been around since 1947. They probably learned a thing or two about 20 groups in that time. So let's be aware. They kind of got it figured out. And Brent's out there running 9 groups, Brent?
Actually, officially, I just took on another one. I'm up to 11 total, 20 groups now.
Wow. So that's why I say, if you want to get Brent in your dealership, you better get on his calendar, because he's a busy guy. And Chris, I know you're busy too. I appreciate you making time to join us. But until next time, folks, I would just remind our listeners that they can find these archive podcasts out there on. You'll find them on YouTube, of course, by following our YouTube channel. And then we're now syndicated across your favorite podcast platforms. You'll be able to find these, listen to them in your truck on the way to the auction or whatever. So until next time, folks, thanks for tuning in to the Tote the Note podcast, and share in the comments how we can help or topics you'd like to hear next time.
Thanks for joining us. please leave a review and don't forget to subscribe to Tote the Note. And thanks again to our sponsor, Neo. Find them at neoverify.com. Until next time.